Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 285. And are you invested in the right sectors? That is the question. As you know, the markets are a very dynamic, changing ones. And from time to time, from week to week, from month to month, you are seeing that sectors are rotating. There are sectors which have not been performing the entire year. There are sectors which perform for a couple of months and go away. So it's very difficult to keep track of, how the sectors are moving, which sectors are gaining strength, when do you want to buy each sector, when do you want to exit each sector, and within each sector then which stocks to buy, how much to buy, when to sell. A lot of these questions are perplexing a lot of users. So we'll take a look at that subject today. In terms of the markets first, markets opened gap up and stayed up the whole day, although in the latter half of the session some profit booking was seen. Pharma stocks still maintaining plus 3% today after a very long time. Pharma has been the second worst performing sector this financial year, minus 6% in the financial year so far. Private banking doing very well. Autos, real estate, metals and consumption stories also doing quite well. So all in all, a reasonably good day. And we've again crossed that trend line which we have tried twice before. And it is a third attempt now. And the Fed speaks tomorrow night for Indian time. And I think Friday will be a key determination of where we are going for now, depending upon the Fed speak on Thursday night. Other than that, all sectors were in the green today, and within the larger framework of mid cap and small cap indices, they were also up 1.37% and 1.15%. CNX 500 also up. All of them were up between 1 and 1.4%. Weekend investing strategies also mostly up 0.6% to 1.8%. Remarkable performance today came from MI20 and MI50, I would say. But other than that, a reasonably good day for all the strategies also. The heat map for the day is largely green, except some pockets of Nestle, Shriram Cement, and some stocks staying sideways like ITC, Levers, Reliance, State Bank, Infosys, TCS. But banking, ICICI Bank and HDFC Bank, Axis Bank doing very well. Finance stocks, Bajaj Finserv, Bajaj Finance, HDFC Life doing very well. Within autos, Tata Motors, Eicher Motors, Bajaj Auto doing quite well. Titan, Asian Paints in consumption stocks, Tata Steel and JSW doing well in steel. But the pick of the day was Pharma, where Sun Pharma up 4.5% roughly, Cipla 5.5%, and I think this is Aurobindo is up 2.85%. Overall performance from FMCG was mixed, with Britannia doing well, but Nestle, Levers and ITC remaining stagnant. In energy pack, we have ONGC doing plus 2%, but Reliance staying flat today. So good day overall. In terms of top gainers, Sri Renuka up 12%, Jubilant up 12%, Advanced Enzymes up 10%, Metro Brand and Birla Corp at 7 and 8% respectively. Triveni Engineering minus 8% today in terms of losers. But remember, this stock had run up a huge amount in the last 2 days. So this is, I think, a reversion to the breakout point, and it may still go up from here. Brightcom Group up minus 5%. Canfin Homes still losing. Go Fashion minus 4%, both of them, and Triveni Turbine also minus 4%. So are you invested in the right sectors is the question. This is a listing of all the sectors that we follow and some indices and some asset classes thrown in, and we compare them on a 1 month, 3 month, 6 month, 9 month, 12 month rate of change basis. And very instantly you can see PSU banks have remained in the top ranks the entire year. whether it over 12 months, whether over 9 months, whether over 6 months, whether over 3 months, whether over 1 month. And IT and pharma have remained the worst performing sectors in this entire year, 6 months, 3 months, 9 months, 1 month, so on and so forth. So this gives you a very clear picture of which are the strongest sectors, PSU banks or banking in general, autos, consumption stocks, the top 4-5 ranks, and which are the weaker sort of sectors or indices mixed. We can separate out the indices also if you like, but that's how the ranking is placed. But this is very difficult to execute. It's very nice to look at, and you've identified PSU banking. Now, how will you go about it? When would you have entered PSU banking? Would you have exited if it had gone to rank 3? Which stocks in PSU banks would you have bought? How much you would have bought? When you should be exiting? All these are real life questions which such analysis does not provide. So you need to create a framework around it to make sure that this knowledge that you're gaining of the sectors can be put to real use. So come in momentum investing, and momentum investing has a solution to this. So it frees you from worrying about which sector to pick, which is in flavor, because automatically the best sectors, the strongest sectors will come into the strategy and weak sectors will go out of the strategy. That is by design how momentum investing will work. So no, trying to outguess which are the stronger ones, which are weakening, which stocks are doing well within the stronger ones. Nothing to do. The momentum investing strategy will just let you know what stocks to buy and what stocks to sell. And I show you by example how this differentiation in sectors happens over the years. So this is every year, September of every year, what are the holdings, majority holdings of India top 10, which is a Nifty product. So we select 10 stocks from Nifty, 50 stocks. And you can see here, September 16, metals and cement formed 40% of the portfolio. September 17, we had metals and financials forming 70% of the portfolio. September 18, we had IT and FMCG forming 50%. September 19, financials and IT forming 70%. September 20, pharma and IT forming 50%. September 21, metals and IT forming 50%. And recently, autos and energy making up 50%. So, sectors are changing almost, this is a yearly snapshot, but they'll be changing even much faster. And as a result of this sectoral shifts, you are able to see this blue line which is outperforming the Nifty by a wide margin. Over 6 years, 344 is the final outcome, starting from 100 versus 229 on the Nifty. Both are not including dividends. So you can improve on the Nifty performance just by staying in the strength of the index. If there are 50 stocks, at any point of time, 20-25 stocks in that 50 are not performing. 10 may be, sideways. 20 may be the ones which have some action going on. And out of that 20, if you pick the strongest 10, you have the cream of the Nifty at all times. Yes, there may be some times when, for a brief moment, things may go topsy-turvy. But from a large sort of long-term investing perspective, you'll stay with strength. Like for instance, for the last 1 year, autos and energy done very well. IT is not at all in the pick. Pharma is not at all in the pick. Real estate maybe momentarily so far. But the strongest sectors are the ones that will stay in. Now, index funds are usually seen as, non-sexy vehicles. You go to a party, you tell somebody, I am invested in index fund. Kya kar raha hai yaar? You should buy some interesting stocks. See, I have put money into this and this, and I've hit a sixer. So what people will not tell you that, you make 40% in 1 year, 40% in another year, and in the third year, if you lose 40%, in those 3 years put together, you've made 17% return total. In index, CAGR of 14% over a longer period. Which is better? Getting 40-40 minus 40 or getting, maybe 20, 10, 15, that kind of a run. You do the math. So, if you want to be the, center of attraction of a party, please keep hitting sixes. But if you want to consolidate your wealth, if you want to compound your wealth gradually, stay with index. The reason is very, very simple. 80% fund managers don't beat the index. You can pick up data from Indian context, you can pick up data from US context, you can pick up data from any market that you like. Approximately, I would say that it may range from 70 to 90. 80% fund managers don't beat the index. Why would you want to do that then? Okay, and you all remember the Magellan Fund story. I don't have to repeat it. Peter Lynch ran the Magellan Fund, 29% CAGR. Most people in the fund did not make even positive returns for that 13-year journey. The reason is that your behavior also matters. There are two aspects to performance. One is fund performance. What is the fund manager doing? What has been the fund performance from point A to point B? Second is your performance. What have you done in that period to move in, move out money, come in with dollops of money at the top, take out money at the bottom, trying to time the market, trying to improve on the fund results by using your own brain. The second part is extremely harmful. So either stick with the fund manager, let him do what he is doing. You've selected a professional to manage or to give you advice, go with that advice. So when you combine these two, that if there are 10,000 mutual funds or 10,000 vehicles, let's not pick out mutual funds only, because that 80% fund managers in PMS also don't beat the index. So 10,000 vehicles are there of financial investing. 8,000 vehicles will not beat the Nifty. Please understand this. So now assume that you are lucky enough to choose from the 2,000 outperformers. Out of those 2,000 vehicles, the millions of people invested in those 2,000 vehicles, 80% of them will still not beat the index. So your probability of beating the index, despite trying to choose the best vehicle, despite trying to behave well in the market, is extremely low. Please understand this. Hence, getting index returns is extremely good if you are able to get index returns. And if you are an index investor and if you are happy getting index returns, then you must consider top 10, the weekend investing Nifty portfolio, because it is designed to beat the index. And it is beaten the index hollow in the run so far. And it will do so in the future, is my guess by design. I will not say a line in stone, but the way it has been designed, I don't think any probability that it will not beat the index over a significant period. So if you want to take a look at that, I'll give you the link in the description below. Another thought for the day, between a bear and a bull. So let's assume nobody is leveraged, just for simplicity. If you are a bear and you only like to short stocks, and most people are not able to do both long and short, because it requires a very different mental framework. A lot of people just want to short. Maybe they are pessimistic in their approach, maybe they can't see anything growing. There are many reasons. There are many people you will meet. Any positive news comes, anything positive happening, they'll say, no, this will not happen. It will come down. Some people have that kind of a outlook. Others may be more optimistic, more positive. So So if you are an inherently positive person, being a bull helps. If you are an inherently pessimistic person, being a bear helps. But a bear can only make 100 rupees if you sell a 100 rupee stock. It will go from 100 to 0 at worst. But if you are a bull and that 100 rupee stock goes to 1000, 2000, 10,000, theoretically the upside is infinite. So the market's design is already loaded in favor of the bull. There is no fair play that is happening. The bear has a low chance of winning, low probability of winning, and the bulls have by design the dice, as they say, the dice is loaded. If you roll the dice, there is high probability of 6-6 coming. That's a loaded dice. That's what's happening in the markets also. The dice is loaded for the bulls. Despite that, if you are not making money, you have to rethink what you're doing. So this is all I have for today's session. Please let me know if these videos are helping you in any way, if they are improving your experience and your knowledge. I certainly think that by doing this, it does help me stay connected with whatever topic that I am choosing, stay connected with Weekend Investing subscribers, and I enjoy doing it also. So please do share this with your friends and family. I say this every day. I know most of you don't. But if you like this content and if you want to acknowledge that this content does have any value, please share it with at least one person in your group who's not accustomed or into the markets. Please make people aware about equity markets. A lot of people, a lot of our friends and family are still considering equities as a gambling den. We must bring them and open their eyes and help them compound and improve their lives. That is the purpose of this all. So with that, thank you very much, and I'll see you in another video. Bye.